There's a nice, clean 90-point pullback that we're seeing on the index.
Indian markets are holding up in the green, but the gain is muted compared to the rest of the pack.
For the markets, we've come off sharply from the highs, 100-point there on the Nifty.
Markets are, what should I say, they are neither here nor there. Absolutely flat is, what the index is at least showing right now. And about, 45 points lower at 18,136. So that's the level at which we will close almost at the day's low, basically.
Hello and welcome to Markets Today, the show where we track about 6 hours of the day's trading action in 5 headlines. I'm Sonal Bhutra. Here are the headlines for the day. A volatile day sees Nifty and Sensex end 0.25% lower on weekly expiry. FMCG stocks were the biggest laggards. Financials outperformed the blue chips. Nifty Bank ends in the green today. India's largest bank, SBI, beats estimates in Q4. Asset quality and margins are the best in 8 years. CEO Dinesh Khara says new rules proposed by RBI on higher loan provisioning are a fiction and one should not wait for it to become a reality. The Indian Banks Association has asked for more time to comply with the proposed rules. ITC meets estimates in the fourth quarter. Cigarette revenue and volume growth in double digits. FMCG business growth at nearly 20%. Hotel revenue has doubled. Restaurant Brands Asia gains after posting a good show in India, but Jubilant Foods skids as analysts diverge in views, weighing short-term input inflation and consumption headwinds against more long-run growth, valuation and M&A prospects. Quest Corp and Teamlease reported dip in growth rates, hurt by a slowdown in IT hiring. Gail tanks after it delivers an operationally weak quarter. Honeywell Automation posts a strong Q4. And here's the lineup of what we have in store for you. It's a packed show today. In the market opinion, we have Dheeraj Agrawal, who's the co-head equities at Ambit Capital. In Big Corporate Voices, we have Anuj Katuria, who's the president India at JK Tyres and Industries. But first up to the day's trading action now. A volatile day saw the markets end in the red on weekly expiry. Nifty and Sensex fell 0.25%, with FMCG stocks being the biggest drag. Financials outperformed, with the Nifty Bank ending mildly in the green. Prashant Nair is here as always with all the details. Prashant.
Well, it was a quiet day in a way. The market ended lower at the low point of the day, but it was a slow burn. We made a high which was initially in the first 30-40 minutes of trade, and after that the market just kept breaking down, but in a very slow, well-behaved fashion, quiet. I think that's a sense one got watching the market all day. A Bank Nifty that ended higher, and I'll tell you and explain with stocks which did well in a bit from now. But losses first, since the markets on the Nifty were lower. SBI and ITC numbers were decent. SBI actually was very good. But the fact is, some of it was pre-positioned, and stocks did sell off after the numbers came out. Divis and Adani Ports were some of the other losers. On the gaining side, it was financials as well. Bajaj Finance, Kotak and ICICI Bank. But, losers outweighed gainers. Market breadth was negative. So let me start with the losses. And a lot of them are just pure earnings-related cuts. GNFC and Gail, JK Tyre, 3 numbers there. And stocks reacting. Divi's Laboratories, Adani Total has been selling off. MTAR, Tech, Godrej Properties, Thermax were decent numbers, but stock was lower. GSFC, Metropolis, and Endurance, which also had reported numbers. There were gainers as well. Burger King, which is restaurants brand Asia, Jindal SAW, Jindal Stainless were big gainers. Honeywell reported good numbers. That reacted in a positive way. Devyani, a similar story there. Shakti Pumps, Indigo Paints, and a bunch more. It's not really clear what the market wants to do. It's been pulling back all week. Global cues will be important. The dollar is rising, and you don't want the dollar up. You want the dollar lower. And some of these important levels in the Nifty, especially the 20-day moving average, will be very much in focus as we come back and trade the last day of this week. Back to you.
Prashant, thank you so much for joining us with those details. In market opinion now, Dheeraj Agrawal, the co-head equities at Ambit Capital, is seeing some headwinds in both IT and the metal space. He also expects some margin pressure in the banking space.
We are seeing some headwinds in IT, largely because of what's happening in the Western world. We are seeing some amount of headwinds in the metals and all commodities space because China growth is not rebounding as sharply as what is required at this point of time for buoyancy in metals. Even in banking, which will account for roughly half, about 44% of the earnings growth in FY24, at some point of time, we will start seeing margin pressure. So there could be a little bit of disappointment from many sectors going forward, and hence the current market hope or expectation of 980, 990 is unlikely to be met.
Okay, that's all about markets, but let's get stock specific now to the second headline. State Bank of India reported robust growth in the fourth quarter, beating estimates across all parameters. Net profit grew 83%, while the net interest margin rose nearly 30%. The bank's asset quality and loan growth improved sequentially. The stock ended with cuts of over 1.5%. Abhishek Kothari joins us with the details. Abhishek, take us through the numbers.
It's been a fantastic quarter for State Bank of India. Take a look at the deposit growth. On a sequential basis, it's at 5%, which is perhaps the best in last 4 quarters and the second best that you are seeing in last 11 quarters. Net interest margin, despite the strong deposit growth, is the best in last 8 years, which has helped the return ratios being robustly on the higher side and one of the best in last 8 years. So the net interest margin has come in at 3.6% when compared to 3.5% in the previous quarter. ROA has improved by 15 basis points to 1.23%, and for the fiscal year ending, the ROE has improved to 19.4% when compared to 18.6% that they had for the December results. Gross NPA ratio and net NPA ratio are one of the best that you are seeing in last 8 years or even more. Gross NPA ratio is down to about 2.78% and net NPA ratio is down to about 0.67%. Now, credit cost for a quarter on an annualized basis is perhaps the lowest ever that they have recorded at just 16 basis point. Restructured book that continues to decline at 0.74% is the lowest in last 7 quarters. On the loan growth, if you take a look at the breakup, corporate loan growth is pretty strong at 5.9% quarter on quarter and about 12.5% YOY. Retail loan growth is also robust at 17.5% YOY and about 5% sequentially. On the flip side, the cost to income ratio that's increased a bit and is on the higher side in last couple of quarters. However, in terms of P&L, both the NI and PAT is a beat on our poll. Back to you.
Good set of numbers from SBI. In fact, SBI Chairman Dinesh Khara spoke about the RBI's proposed expected credit loss rules that are supposed to kick in from 2025. The proposed rules will mean higher provisioning for banks, and the Indian Banks Association has asked for more time to comply with the norms. SBI Chairman termed the proposed rules as fiction, adding that we should not wait for it to become a reality.
First and foremost, ECL as of now is a fiction. And if at all it becomes a reality, we are very well equipped to deal with without having any impact on our balance sheet. We have always followed the principle to insulate the balance sheet fully, and our balance sheet is completely insulated from any future potential events also.
All right, moving on to the third headline now. ITC declined over 1.5% despite a decent fourth quarter. The FMCG major reported a net profit of over 5,000 crore rupees, beating street estimates of 4,900 crore rupees. Revenue figures also met expectations. Manglam Malu is joining in with the key highlights. Manglam, a fairly decent quarter for ITC.
Well, these are largely in line set of numbers coming in from the cigarette business for ITC this time around. I'm just looking at the cigarette revenue growth that's coming at around 14%. The street was working with a number around 15-odd%. So this means that the volume growth for the company has been around 11 to 12%. Again, largely in line with expectations of 12 to 13%. The cigarette operational performance has seen an improvement about 14% year on year. Again, in line with expectations of 15 to 16%. What really has stood out this time around from an ITC numbers standpoint, of course, hotels has grown in triple digits as against a 40 to 50% growth expectation, but that again, does not surprise the street as much given the sort of numbers that we've seen from Indian Hotels and Lemon Tree. The star of the numbers this time around for me is the FMCG business that has shown a revenue growth of 19%, and for the first time ever, the FMCG EBIT has reported a double-digit margin. So that's a margin of around 10.2%. That's a big positive. So this is something that we'll have to watch out for. ITC is finally moving away from the shadows of the tobacco business and coming onto its own in the FMCG pack. So that really, is something that my key takeaway from these numbers would be. Volume growth, nothing really to worry about. The agri business has seen a decline of about 18-odd%. Again, the street was working with a decline of around mid-teens, largely because of a high base. And, the wheat export has been banned this time around as well. So wheat exports were there in the base quarter. The other businesses of the company, the paperboards business has shown some sort of moderation. But while on a reported basis, just the P&L has been largely in line with expectations. The cigarette volumes in line with expectations. The FMCG really stands out with the hotel business reporting a near doubling of revenues on a favorable base. Let's see whether that continues or not.
Okay, inline set of numbers coming from ITC. Mangalam, thank you for that. Now let's move on to the action from the pharma space. IPCA Labs and Torrent Pharma fell in trade. This after CNBC TV18 accessed a Form 483 issued to IPCA Labs Silvassa unit. Separately, we learned from sources that the US drug regulator or the US FDA is conducting a routine check at Torrent's The Hague unit. Ekta is joining us with all these details. Ekta.
Torrent Pharma sources have indicated to me that the US FDA has begun an inspection of the company's The Hague facility. The inspection began this week. It is expected to be a routine CGMP inspection, which means that it's a current good manufacturing inspection to check if everything is in place within the plant. The company's The Hague unit, interestingly, was classified as official action indicated in July of 2019. So it has been under the US FDA's scanner since pre-COVID times. And since then, they haven't really been supplying to the US from this particular plant. They do have the Indrad facility, which is under the scanner as well. So from that context, this becomes an important inspection. As of now, Torrent Pharma does not have any kind of comment with regards to this story. Let's see, in the next couple of days, we should probably even get an idea in terms of the observations which have been issued as well. Now, separately, IPCA Labs is in focus because we've managed to access the Form 483, which is the number of observations which have been issued to their Piparia facility in Silvassa, which is in Madhya Pradesh. They were issued 3 observations to this plant, which was inspected from the 18th to the 26th of April. It manufactures formulations. This plant has been under an import alert all the way since March of 2015. So that's in that context, this becomes quite important in terms of a facility. Now, remember that 3 of IPCA's facilities have been under import alert since 2015, Piparia, Pithampur, as well as the Ratlam facility. So in that context, again, this particular inspection and the observations which have been issued become important, because if they do see any kind of clearance, then obviously they would probably be able to resupply to the US. Just want to point out that I did go through the observations with a couple of experts, and they have indicated that despite the fact that there are 3 observations, it still looks probably a little tougher for them to solve.
Okay, all right, Ekta, thank you so much for that. But let's stay with pharma stocks. Zydus Life Sciences stumbled over 2.5% on the back of a huge net profit miss for the 4th quarter. The pharma company reported net profits of over 290 crore rupees versus an expectation of over 700 crore rupees. However, revenues and margins came in much higher than estimates. Zydus Life has incurred a one-time loss of over 600 crore rupees, which has impacted their profit numbers, and that's the reason it looks lower in trade as well. Okay, let's now turn the spotlight to the MFs. It is facing a lot of pressure in COVID-19, that is the MFI space. The microfinance sector has seen some depression on the back of this. The 4th quarter has been one of the best quarters for the sector. Abhishek Kothari is here with the detailed report on their performance. Abhishek, over to you.
Well, one of the best performance in Q4 FY23 has come in from the microfinance sector amongst BFSI. So the sector had faced huge pressure due to COVID impact seen in 2020 and 2021. The return ratios, the net interest margin profile are back to pre-COVID levels. Even the customer acquisition growth rate or the number of customers are either back to pre-COVID levels or better than that. Most of the players have witnessed increase in net interest margin. So net interest margin on a YOY basis has increased for 5-star finance, Satin Credit Care, while net interest margin has increased quarter-on-quarter for Equitas Small Finance Bank. Net interest margin has declined both YOY and quarter-on-quarter for Ujjivan Small Finance Bank, while the increase both YOY and quarter-on-quarter has been seen for Credit Access Grameen and Spandana Spurti. Asset quality improvement continues to be led by lower slippages, higher write-offs, or either bad loans being sold to asset reconstruction companies. Credit Access Grameen has the lowest gross NPA ratio in the sector at 1.21%, followed by 5-star finance. So IndusInd Bank has the highest gross NPA ratio amongst MFI financiers in the MFI portfolio. MFI players have seen their quarter-on-quarter loan growth being between 8.5% to as high as 27.8%. Now, this rate is way above the overall banking sector credit growth rate of around 4 to 5% quarter-on-quarter seen in Q4 FY23. However, one needs to take this loan growth with a pinch of salt, given the fact that proportion of interest in the EMI has actually increased and the proportion of principal repayment has reduced. What this means is that it has does push the loan growth to be on the higher side over the next 1 year. As and when you see higher principal repayment in the EMI, this can lead to some moderation in the loan growth from current levels. Credit growth, however, will remain strong for the sector as guided by the management of Credit Access Grameen. In terms of valuations, based on FY23 book value, Satin Credit Care is the cheapest amongst all the peers, trading at less than 0.9 times price to book value FY23. Good companies always commands premium seen in the valuations of Credit Access Grameen and 5-star.
Okay, all right, Abhishek, thank you so much for that. Let's take a short break now. We'll be back with the market headlines in just a bit.
Let's you and me step out and see how blue the sky, how tall the trees.
Skoda brings you Kushaq and Slavia, India's safest family cars.
My dad has won a medal for bravery. He's a major in the army. He protects everyone. Karan, what does your dad do?
Rohan, your daddy.
Karan, tell us now.
He's an LIC agent.
That's great. Imagine what if something untoward happens?
So?
Well, Karan's dad provides proper guidance to protect our family's future.
We are proud of our million-plus agents who continue to protect countless lives. We welcome you to LIC. Visit your nearest LIC branch.
Zedblock Premium Agarbatti and Dhoop, official prayer partner, Delhi Capitals.
From navigating adversity to spearheading innovation, business leaders in India have been the architects of country's inspiring story of resilience and resurgence. Catch all the highlights from the 18th edition of India Business Leader Awards that honored these visionaries of India Inc. at this time, only on CNBC TV18.
Presented by Standard Chartered. In partnership with Hindustan Times. In association with Reliance Industries Limited.
Burst of colors. Feels like a billion rainbows in my hand.
Welcome back. You're still tuned into Markets Today. Let's go to the rest of the headlines that we are tracking for you. The fourth headline now, Restaurant Brands Asia rallied 14% after it delivered in the fourth quarter number. That was a strong performance from its India business that aided sentiment. Manglam Alu is back with us with more on this one. Manglam, take us through the highlights of those earnings.
No divided opinion on the India part of their business for sure. The burgers of Burger King looking good this time around. Good performance coming in from the India business. Indonesia, yes, losses did expand, but the India SSSG was 8.3 odd %. So just to run you through the numbers, 29% jump is what we saw in their overall consolidated performance in terms of revenue, 35% jump on the EBITDA. On the bottom line, the company makes a net loss, but remember, this is largely on account of depreciation. So on a cash basis, they are still profit making. India geography, the revenues grew 36%, the EBIT grew by 40%. That meant a margin expansion of nearly 40 basis points. And what the street liked a lot more was the commentary of the management. For Indonesia, they have a target of achieving cash break-even in FY24. At the same time, while they opened 88 restaurants in India in FY23, their target is to reach 450 restaurants in FY24 itself, with an SSSG in double digits. And at the same time, they are targeting gross profits of 67%. But by and large, also remember that this is a company which is owned by a private equity player. So intermittently, you keep getting news pieces about there being a deal on, or the company itself being on the blocks. So that's another reason why the stock moves as well. But apart from that, fundamentally as well, the India business for them doing well.
Okay, all right, Manglam, but you have to stay with us. Jubilant Foods fell over 1%. This is after analysts came out with divergent views on the stock. Take us through the bull and the bear case on this one.
But as far as Jubilant Foodworks is concerned, whether you're a bull or a bear, the street is as divergent as one's opinion on their pizzas itself. The bulls are saying that this is a structurally long, consumption sort of market. At the same time, the company focusing on their same-store sales growth through the 20-minute delivery that they've launched right now in Bangalore, try to scale it up everywhere else. They're confident of sustaining margins at current levels, so their scale really helps them. At the same time, the stock has underperformed the broader market in the last 1 year or so. It's down 50% from its all-time high. So maybe, much of the downside has been already played out. The company has been sharpening the value proposition, and that can surprise the like-for-like growth in the second half of this year. And at the same time, a successful scale-up of Popeyes could be an optionality too as well. But bears, they say that there are margin headwinds, at least in the next couple of quarters, coming in from milk inflation, specifically cheese inflation as well. And on demand recovery as well, the outlook is uncertain. Higher FY24 capex, despite lower number of store additions, is something that the street doesn't like. The company is guided for 225 stores to be added in this fiscal, as against 240 that they added in the previous fiscal as well. CLSA has said that they have a sell rating on the stock with a target price of 460. Margins have dropped to the lowest in the last 11 quarters, but at the same time, they've said that de-rating for the stock is largely over. HSBC maintaining a buy rating with a lower target price of 620 rupees, whereas UBS says that they are long-term believers of the potential in Jubilant Foods, as a result of which they too have a target price of 600 on that counter.
Okay, all right. Thank you so much for that, Mangalam. That's about the FMCG space. But moving on to the fifth headline today, Gail fell close to 4% after a big miss in the fourth quarter. It reported an operationally weak quarter across all the segments. The stock was lower by 3.5%. The petrochemical segment, it continued to actually report a loss, which has expanded. There was an expectation that it will contract on a quarter-on-quarter basis. The peers like IOC and Reliance Industries did see an improvement in petrochemical spreads, but that hasn't come about for Gail. The marketing segment EBIT came in at 487 crore rupees versus an estimate of 1,000 crore rupees, so that's a big miss again. So looking at the numbers, revenue is at 32,858 crore rupees. Of course, it will be a sequential recovery, but the numbers are much lower than what the street was working with. Margins at 0.9% versus 0.7%, which compares with a poll of 4.3%. Profits at 600 crore rupees versus an expectation of 1,043 crore rupees. Now, in terms of the segments, it was a big miss all round. The gas transmission business saw a loss this time around of 16 crore rupees. LPG transmission saw a decline on a quarter-on-quarter basis. The marketing segment, which I said earlier was expected to see EBIT of 1,000 crore rupees, reported EBIT of 487 crore rupees. Petchem EBIT actually expanded in terms of a loss, 400 crores rupees of loss here, and LPG and liquid hydrocarbons also saw a decline. Now, a couple of one-offs in the transmission segment, which is the biggest one here. They made a provision of 180 crore rupees towards the loss and rerouting of Kochi-Mangalore pipeline. The second was they booked a one-time loss of 150 crore rupees towards the gas handling cost. Additionally, there was a deallocation of APM of 0.2 MMSCMD from 1st of Feb, 0.3 MMSCMD from 15th of March, and currently they are getting APM of around 0.6 MMSCMD. So, of course, the gas has been coming in at a lower volume, so that definitely impacts their transmission realizations. A couple of reasons why the stock was weak in trade on the back of a weak set of numbers. That's about Gail. Moving on, JK Tyre tumbled nearly 10% despite reporting a strong fourth quarter number. The company's revenue has grown over 9% on a yearly basis. EBITDA has come in 65% higher versus the same quarter last year. Anuj Kataria, who is the president India at JK Tyre, expects double-digit revenue growth in FY24, adds that they will reduce their debt from current levels as well.
We saw a growth of 22% in the top line, a consolidated revenue of 14,681, which was the highest ever for us. Quarter 4 also was a good quarter, where we had a revenue growth of 10%. More importantly, the margins were there. In quarter 4, we posted a double-digit EBITDA. So going forward also, we see that the demand is quite buoyant, both in the commercial vehicle segment and also in the passenger cars. So we expect that we should be seeing a double-digit growth in FY24 as well. We were at a level of close to 5,000, a shade under 5,000. Now we have brought it down to around 4,500 crores. And we expect that going forward, as we had earlier mentioned, by 2025, we should be able to get it down to the 3,500 mark. On the margin front, yes, the raw material prices as of now, thankfully, they are quite stable. We saw stability coming in quarter 3 last year. Quarter 4 saw a reduction. And we expect that going forward, the prices, the raw material input costs should remain stable.
Okay, all right. That's the word coming in from JK Tyres. In more earnings now, Quest Corp and Teamlease fell between 1 to 2% after they reported a dip in growth rates hurt by a slowdown in IT hiring in quarter 4. The staffing majors also witnessed a margin compression as the going gets tougher. Rima Tendulkar is here with the details. Rima.
Hi, thanks so much for that. So Teamlease and Quest Corp are both staffing companies. While majority of their revenues come in from general staffing, where they provide not the specialized services, but they do get some portion of their revenues from IT hiring, and IT hiring is slowed down, which is why these companies have reported slower revenue growth. So the revenue growth for both these companies has been slowing down on account of specialized hiring, particularly IT hiring coming down. So take a look at Teamlease, for instance. Revenue growth has slowed down to just 1% on a quarter-on-quarter basis. Year-on-year revenue growth is at 11.5%. This compares with about a 35% revenue growth that it had same time last year. As I said, the headwind is on account of IT hiring. For Teamlease, the specialized staffing revenues have come down by 4.5% on a year-on-year basis. The company is also facing a hit on account of realizations. So EBITDA margins have been declining. EBITDA margins are stable on a quarter-on-quarter basis, but lower on a year-on-year basis. In fact, just take a look at the FY20 annual margins for the company at 1.6%. FY23 EBITDA margins, this is the lowest that we've seen in the last couple of quarters. For Quest Corp as well, it's a similar story. Revenue growth is at 17.1% on a year-on-year basis, lower than the growth rate over the last couple of quarters. EBITDA margins have come down on a year-on-year basis at 3.4%, and that's driving a 50% plus decline in the company's profitability. Back to you.
Reema, thank you so much for explaining what happened with these staffing companies in the quarter gone by. With that, it's a wrap on this edition of Markets Today. Thank you for watching.